Home Depot's biggest miss. They're saying it's a year of moderation for the home improvement markets. That's as Home Depot just posted its worst revenue miss in 20 years. Check this out.
The earnings actually came in better than expected on the bottom line, 382 versus 380. The revenue was a miss, 37.2 billion versus the 38.28 billion estimate. The big deal, though, is the guidance that they're giving for the full year. Comps, by the way, for the quarter were down 4.5% versus down 1.6% for an estimate. But for the full year, the company is now saying that it expects revenue to be down 2 to 5%. Before this, it had only been looking at down 0.7% for the estimate. For the full year earnings per share, they're now looking for down 7 to 13%. The estimate before had been down 5.7%. And as a result, you see that stock down 3%, down 4%, bouncing around a little bit. You also see the Dow futures now off by about 115 points. Becker, who is the chairman, the president, and the CEO, says our sales for the quarter were below our expectations, primarily because of lumber deflation and unfavorable weather, particularly in our western decision as there was some extreme weather in California that they said disproportionately impacted their results. However, the guidance for the year goes well beyond this quarter and what weather they're anticipating with this home improvement market.
Now, you guys heard that. A year of moderation for the home improvement market. Now, that's a nice way of putting it. I think things are going to get really, really ugly for Home Depot and the real estate market in general. Not only folks that are stuck in their homes because they just can't up and sell and move next door since it's just way too expensive, but now they're also strapped for cash and can't even fix up or even remodel their homes anymore. You walk into these stores and you almost have a heart attack whenever you see their prices. There is no reason for these prices to still be this high. The supply chain is not even an issue anymore. It's all BS. Pure greed, if you ask me. Now, the home flipping game is toast. It's done, at least for now. So brace yourselves for the next phase, a good old-fashioned real estate crash. Now, JP Morgan Chase CEO Jamie Dimon is warning the same thing about the commercial real estate downturn. Jamie Dimon warned at his company's shareholder meeting that the regional banking crisis is having a knock-on effect on commercial real estate lending and that these sourcing commercial real estate loans could threaten some banks. It's going to get worse here, folks. So it's not just the real estate market, but the banks too. I mean, deposit runs have led to the collapse of already 3 U.S. banks this year alone, but this is another concern that's building on the horizon. Now, as for regular working class Americans, rent is growing faster than incomes around the country, putting additional pressure on inflation burdened households. Now, it says here, the median renter in the United States would need to spend 29.6% of their monthly income on average rent in the first quarter of 2023. So I got to ask you guys, how's your rent looking? Tell me a little bit about it in the comment section down below. But hey, there's a new study that came out about where to rent the largest urban apartments for $1,500. Plus, build to rent housing is also on the rise. I wonder if people are still interested in buying those tiny houses. Anyway, I want to know what you guys feel about that exactly. It's not exactly the American dream to rent a home, you know, but hey, let's take a look at it nonetheless. All these real estate updates coming to you guys in one quick, easy to share video. So definitely stay right there. And if you already own a home, make sure your home is protected. Get your free home warranty quote. The link is in the description down below. Never be caught off guard again by another very expensive, unexpected home repair again. Get your free home warranty quote. Link in the description down below this video. So here's the deal, guys. Home Depot, they just took a hit. They lowered their sales forecast for the year and posted their expectations that their profits would decline even more than expected. Now, this has got people worried about inflation and thinking twice before spending their hard-earned cash on non-essential discretionary spending. Now, as a result, Home Depot stock took a nosedive, dropping about 4%. And even their rival Lowe's, they weren't spared, with their shares going down almost 3%. Let's face it, Home Depot and Lowe's, they pretty much had the best sales year ever during the pandemic. They both set records during that time period. The fact that Wall Street ever thought that those numbers could be maintained is just beyond ridiculous. And Home Depot isn't exactly the most organized operation. Every time I go into the store, they always have aisles blocked with gates and pallets because, you know, they're using a forklift stocking the shelves at noon. They need to be more like Costco and Walmart, you know, someplace really efficient. Especially now, things are beginning to return back to normal and all the hype around home improvement stores during the pandemic pretty much fizzled out. Americans are now cutting back on remodeling their homes, and on top of that, inflation is making people just a little bit more gloomy about spending money. In fact, consumer sentiment hit a 6-month low in May. Now, according to Executive Vice President of Merchandising at Home Depot, the demand for things like patio furniture, grills, appliances, flooring, and kitchen and bath items has been weak. People are shifting their focus toward travel, vacations, and other services instead. All of these factors led to a 4.5% drop in quarterly sales, which is even worse than what the analysts were predicting. They thought it was only going to decline like 1.74%. Now, experts are shocked to say the least. According to them, they're saying, quote, "It's definitely a surprise. The speed and the magnitude of the weakness is surprisingly relative to what we were thinking," end quote. They also said here, quote, "The U.S. consumer is a little bit more uncertain than they were a few months ago," end quote. A little bit more uncertain is definitely a nice way of putting it, isn't it? What do you guys think? I say barely getting by is a little bit more accurate. And let me tell you guys, this is bound to get worse. You got JP Morgan Chase CEO Jamie Dimon. He's already sounding the alarm over commercial real estate loans and the possibility of even more banks folding under the interest rate pressure from the Federal Reserve. He talked about indirect consequences, aka offsides. He said, quote, "There's always an offsides. The offsides in this case will probably be real estate. It'll be certain locations, certain office properties, certain construction loans. Could be very isolated. It won't even be every bank," end quote. Translation, the regional bank crisis is having a knock-on effect on commercial real estate lending. Regulatory changes made in response to the collapse of Silicon Valley Bank and Signature Bank will also likely lead small banks to tighten access to their credit. And as credit tightens up, interest rates could go even higher. And as Jamie Dimon put it, quote, "You're already seeing credit tightening up because the easiest way for a bank to retain capital is not to make the loan," end quote. So pretty soon, Dimon thinks everyone should be prepared for rates going higher from here, end quote. So people are going to hit a credit crisis pretty soon. I mean, just imagine not being able to use your credit cards or your credit card just straight up getting canceled without your knowledge. What a nightmare. A big problem area here could be the commercial real estate market and the banks that handle the commercial real estate loans. You see, banks here in the United States, they have been enjoying crazy low loan defaults for a long time now, all thanks to super low interest rates and the flood of stimulus cash that came pouring in during the C-19 pandemic. It's kind of like a real sweet deal for them. The Federal Reserve decided to hike up interest rates to tackle inflation, and that has pretty much shifted the ground under these financial institutions. In certain markets, especially tech-heavy San Francisco, commercial buildings might take a huge hit since remote workers are just not going to be going into the whole office scene anymore. And guess what? It only gets worse from here. The stress on the banks has added fuel to the fire. Those small and mid-sized banks that lend to commercial real estate developers and managers, they're feeling the pressure on their finances. See, around 80% of all bank loans for commercial properties come from those regional banks. So what happens when most of these bank loans default because these properties can't keep up with payments? So yeah, it's a tough situation all around. I heard from an electrical contractor recently. In 2008, they wired 22 new homes. In 2009, they did 0. They did a lot of remodel work. They recognize everything we're now seeing and try to tell people. They even had realtors tell them it can't happen again. There are safeguards in place now. And well, here we are. They're doing good. They have a good customer base and they're pretty well established. By the amount of phone calls that they get per week, things are markedly slower. It's time to get the word out, guys. Hit the share button right now and share this video with your friends. And the rental market. Oh, don't get me started on the rental market. So rent is growing faster than incomes around the country. Now that's some additional pressure on already inflation-burdened households. Now it says here the median renter in the United States would need to spend 29.6% of their monthly income on an average rent in the first quarter of 2023. Why does it feel like more than 30% of our income? Don't you guys agree? Moody's Analytics said that we're at an uncomfortably high ratio. And the rub? It's still cheaper to rent than to buy in the vast majority of the United States, according to a Redfin report out last week. There are only 4 major metro areas in the United States where a typical home has a lower monthly mortgage cost than its estimated rent. Back in 1999, New York City was the only rent-burdened metro area in the United States, meaning renters paid 54% of income for rent. By the end of last year, there were 6 metro areas in the pricey club, including Miami at 42%, you had Boston at 33%, and Los Angeles at 35%. So how's the rent where you guys are at? Are you still keeping up? Let me know down in the comment section down below. Now, I mentioned 4 areas that you might want to check out. Now, this new study shows where to rent the largest urban apartment apartments for $1,500 a month. If you like living in a larger city but you don't want to give up your space, Wichita, Kansas could be the place for you. It ranked #1 on the largest city list of places where you can get the most square footage, 1,463 square feet for $1,500 per month. Not far behind that is Toledo, Ohio, where you can get 1,379 square feet of space for $1,500. Now, when it comes to smaller U.S. cities that offer the most space for the cheapest rent, Columbus, Georgia, it takes the #1 spot, offering 1,545 square feet of space for $1,500. In second place, in McAllen, Texas, there you can get 1,471 square feet of space for $1,500, but the temperatures hover above 90 degrees for most of the days of the year. Anybody here from these places? I would love to hear from you guys on this. Let me know what you guys are seeing out there. Now, some real estate companies are even going into the build to rent housing. So basically, they've given up on trying to give people the American dream and just double down on tying up people with leases instead. They make it sound so good too. Listen to this, quote, "Build to rent housing can provide the opportunity to move into a brand new house, often with professional property management and other amenities attached, without the need to raise a huge down payment or a long-term commitment to stay in place." End quote. It's kind of enticing, right? Then they raise the rent sky high. It's just ridiculous if you ask me. Now, from the way that things are, the future is not looking all that bright. Inflation's not really going anywhere, guys. It's sticking around and everything's still getting worse. And you know what that means? People are going to feel the squeeze, especially when their credit card debt keeps piling up higher and higher. It's going to hit like a ton of bricks. Pretty soon, people won't just be skimping on patio grills, patio sets, and furniture. They'll be cutting back on toolboxes, tools, and even lumber. It's a tough spot to be in, you know? So what's the plan? Well, people are starting to wise up. They're tightening their wallets and they're hunting for bargains. Even those successful, savvy folks out there who are doing pretty well financially, they're holding back too. They see what's going on. They're not splurging on fancy new cars or blowing their money on frivolous stuff. Nope. They are playing it smart. They're paying off their last bits of debt and saving for a big win. It's the masses who haven't caught on quite yet. Meanwhile, the successful ones are just sitting back, biding their time and saying, hey, you know what? I'll hold off on that shiny new car for now. We'll come back for that in a little bit. They're in a holding pattern, focusing on paying off debts and building up their savings. They know the game and they're playing it smart. Now, my advice, hold off on any major purchases. Pretty soon, people are going to be priced out of the stores, and even the stock market may even offer huge discounts on everything. Just wait and see. More on the next one, guys. I hope you caught all of the information in this video. Right now, you should see 2 important videos right here above my head. Be sure to check those out. So guys, this was your real estate update and daily news report. Home Depot and JP Chase raising major red flags for the company, for the economy, and the financial markets. Plus, my own thoughts on holding and waiting during this time. I want to thank you guys so much for always watching. A double thanks for always lighting up the like button. Don't forget to share this video with your friends and family and subscribe to the channel. I'll see you guys on the next one.